This video, we will explain about consolidated or financial statement, particularly statement of financial positions in advanced level. So this is on the acquisitions of stakes in another company. If you are the parents and you are intended to invest in other company, the holding percentage will decide your accounting treatment. So in here, if let's say your holding is less than 20%, we will call it as a normal investment. Call it as a financial asset under IFRS 9, financial instruments. We are going to refer to the IFRS 9 to do necessary adjustment. For example, if it is a financial asset, investment in equity held for non-trading purpose, we are going to measure at fair value through OCI. Any changes in fair value, we will put it under OCI. So this is the most simplest and the direct way of accounting treatments on investment. So if let's say you move beyond than 20%, for example 20 to 50%, you will fall under significant influence category. So this significant influence means you are be able to significantly influence the decisions of the another company, and this will be called as associate. So that particular related company will be called it as associate. And using associate, we will treat it using equity accounting. So equity accounting will be our measurements method. So technically, equity accounting, we are going to use cost plus any subsequent retained earning after you invest this associate. You have all the subsequent retained earning, you are able to share on it. So I call it a share of RE of your associate. So your value of your associate, your carrying value of your associate will be formed up using cost of investment of associate plus every year share of retained earning. And that will be your equity accounting method. Also some sort of straightforward. The last one will be the more complicated one, or we call it as control. Control means you are able to having a power, the ability to use the power in terms of expose or right to vary the returns of the investee company, then you are having a control. So in numerical perspective, as long as you are hold more than 50%, meaning to say more than or equal 51% and above until 100%, this relationship is considered parent and subsidiary, where you have demonstrated control over your subsidiary and you should console your account with your subsidiary. According to IFRS stance, there could be some situations whereby your holding is lesser than 50%, meaning to say you are under significant influence, but you have a special arrangement or so-called a shareholder arrangement saying that you have a direct ability to participate the activities of the investees, then this also can be constituted as a control. So that will be a separate topic. Today we're looking at the quantitative perspective, whereby if more than 50%, what you're going to do? So you need to do consolidations, meaning to say combine your parents' account with the subsidiary account into one account. So we call it as group account. So let's start with the subsidiary. So in this question, you are able to see we have a straightforward relationship. P by over S. Given the informations of P and given the informations of S. So if P acquires 600 unit of shares in S on 1st January 20x5, when its pre-acquisitions retained earning of S are reported as 500. And how are we going to do consolidations? First thing first, we need to identify the holding percentage. So if P hold over S, P buy 600 unit of shares of S. So we know this 600 unit is the number of unit of shares. And in the S company, we have 1,000 shares in terms of Ringgit Malaysia, RM. But this shares is $1. So meaning to say, 1,000 divided by $1, we are still getting 1,000. So the holding will be 600 divided by 1000. So we know that we are holding P holding S at 60%, and therefore NCI will be carried at 40%. So NCI in full name means what? Non-controlling interest, or we call it as MI, minority interest. Those interests that is not under your control. So it's other small portions of the shareholders. So in here, we can look at your P financial statement. You invest 1,002, meaning to say you paid 1,002 to buy over 60% of shares of S. So in this case, our initial recognitions of your consolidations, first very important steps will be your goodwill. So we will need to calculate our goodwill. So in goodwill, technically is trying to assess when you are doing an acquisitions, if you spend more than what the company actually worth, the extra portions we'll call it as goodwill, meaning to say you are paying extra to take over the company or to buy over certain portions of the shares of the company. For instance, like these questions, we have our considerations. So let's take our considerations that paid by our parents, which is 1,002. So this 1,002 will be my starting. And then I would need to include NCI. What is the reason of including NCI? The total company is 100%. If you invest 60%, the another 40% will be belongs to NCI. So this is a very important message. And this NCI, there will be two methods for us to calculate. First method, method A, I call it as full goodwill method. So this full goodwill method, normally in other name, we will call it as NCI value at measured at fair value. So meaning to say, we are looking at the NCI in the market value. So question normally will give it to you directly. For instance, I just assume that question said this 40% represents 600. So this is given by the question. So meaning to say the 40% of the shares held by NCI currently is actually measured at 600. Therefore, the total company 100% is actually worth 1800. Therefore, we will need to less our net asset identified. So this net asset identified is the net asset identified at acquisition date. At acquisition date. So what is net asset? Net asset actually is our asset minus liability, which is also our equity. So on the acquisition date, you should take your shares at the acquisition date, which is 1,000. And do remember, don't use 2,000 because this is post-acquisition retained earning. You acquired on 1st January, and in 1st January, they told you that the pre-acquisition retained earning is 500. Instead of using 2,000, which is after 1 year, 31st December 2005, you should use 500. Therefore, I will put a 500 in here. This is my pre-acquisitions. Always remember, pre-acquisitions retained earning. And that will be my sum of net asset. Ultimately, what I do in here, I will just minus off. And that will be my goodwill. So let me just complicate the entire situations now. So if question asking you another method, we call it as method B, partial goodwill method. So partial goodwill method, there's another name called NCI at proportionate. What does it mean, NCI at proportionate? So this is very interesting. Question won't give you the fair value of NCI. You will need to calculate by yourself. So this is blank. You don't know your goodwill. And based on the proportions of NCI, we will base on the net asset of the subsidiary. In this case is 1005. I will use 1005 times the percentage, 40%. Meaning to say, my net asset, my NCI at net asset value, 40%, 600. So this is measured at the 1005 times 40%. So meaning to say, our situation here is actually quite similar because here is 600, here is also 600. What if now I'm telling you that actually in market value, NCI is much more higher? Example is 500, 800. My goodwill will increase in full goodwill method. Here is lower, correct or not? So now, what is the goodwill that we will have in the partial goodwill method? 300. So with this method, these two methods, we are able to see that full goodwill method, your consideration based on the market value, the arm's length transaction that you paid to acquire the 60%, and the NCI also based on the fair value, the market value, is not using the net asset times 40%. It's based on market value. So this is what market tells you, and this is what the company really worth. You need to think about like you are entering into a deal. So the net asset is actually the book value of the company. Like in the financial statement, SOFP particularly, your net asset is actually worth 1005. So people might be able to pay higher to buy over your company. So in here we are quite optimistic. But in here, right, partial goodwill, considerations is the arm's length transaction that we paid. But the NCI, we are not using market value. We are using the net asset 40%, 600. So these are the two different methods. Actually, it's very simple in terms of this. But if let's say I further complicated the situations whereby if let's say I am having an impairment of goodwill, and my impairment of goodwill now is actually okay, just let's assume 100. Then my final goodwill here is 400. My final goodwill here is 400. Likewise, for my partial goodwill method, become 200. So there will be one very complicated situations will be happen in here. If full goodwill method, both parents NCI are measured at fair value, market value. If there is impairment related to this goodwill will be shared between parent and NCI. Please be reminded that parents is you. NCI is the portion that is not belongs to you. It's other people. You don't know who are them. So parents will share the impairment 100 times 60% based on their holding, which is $60. Whereas for NCI, 100 times 40%, they will share $40. These two, we are going to put it, parents, they are going to minus your retained earning because it is an expenses. Expenses will reduce your retained earning. And this one will reduce your NCI. Later we will see that. So this is full goodwill method. What about partial goodwill? Partial goodwill, NCI is really measured at net asset. They doesn't measure anything extra than what they really record in the SOFP. So the only things that cause this goodwill, there is a goodwill, is because of our own parents' arm's length transaction payment to buy over the 60%. Therefore, if let's say we have an impairment, that impairment of 100 should be entirely absorbed by parent instead of absorbed by NCI, because it is not fair to ask them to absorb because they already stated at net asset. They are not using market value. So if let's say NCI at fair value, this is full goodwill method, your impairment of goodwill, you are going to absorb together with them. But if partial goodwill, NCI won't share your goodwill. So this is the key differences. And after you calculated this, right? So the next things is that we will need to calculate the retained earning. Let's calculate retained earning. So the group retained earning, okay, we will need to share what is my console retained earning, because now we need to combine. So to combine as one, we will need to check out our P and S. So this is my P, this is my S. So I will need to tag my post acquisitions retained earning as a starting, as per questions. Parents, now we are closing this 31st December. So parents retained earning 3,000. Subsi retained earning at 2,000. Retained earning means what? From the first day you start the business until now, how much is the total profit at this date? This is called retained earning. But please bear in mind, you are investing on 1st January. And if let's say I would like to draw a timeline, and this is 1st of January, and this is my closing, which is 31st December 2000x1. Before that, you already accumulate 500k, because they say on 1st January, your RE at 500. Then on 31st December, your RE at 2000. Questions. You invest, you are able to share their retained earning, because this is the reason why you want to invest. But can we use this 2000? The answer is no, because you only involved in this period. Therefore, in order to share the relevant period profit or retained earning, you need to use your 2000 minus 500. Then only can times with the 60%, that will be the portions that we can share. Therefore, your group retained earning, we always have a very important working here, where we use the post-acquisitions minus the pre-acquisitions retained earning. And in here, as pre-acquisitions is 500. So I only can share 1,005, because 1,005 happened in this period, is related to me. Before that, the 500 is none of my business. I didn't invest. So I need to use 2,000 minus 500. I only take whatever happened in this period. Before that, ignore. This is the reason why we need to minus pre-acquisitions retained earning. So we will have this. And subsequently, once we got the amount, and we are going to share it. So we are going to share of RE. So share of SRE. SRE. So S got 1,005 times 60%. So 1,005 times 60%, that will be my sharing. Another 40% NCI. And that particular amount, don't forget, following this method. So this side will be my full goodwill method. Please bear in mind. So this side, full goodwill method, me as a parent, I will need to share the parents' portions of impairment. So this is my impairment goodwill. So impairment of goodwill, 100 times 60%. I will share the $60. And therefore, my amount will be 3840. So this will be my group retained earnings. Then my NCI. My NCI value also will increase. This is my initial measurement. Subsequently, my earning will be increased because my subsidiaries is contribute profit to me. And my NCI when subsidiary earning, NCI value also will increase. So in terms of your NCI, our initial value will be the NCI at pre-acquisition date. So NCI at pre-acquisition date, you can look at your goodwill. Can you see initially your NCI measured at fair value 800? So 800 will be your fair value. And just now 1005, 60% to them, parents, 40% will going into NCI because NCI will get the 40%. And therefore, that will be the share of as retained earning by NCI. So this is 40%. And don't forget, your impairment, you need to minus here, you also need to minus in here. Whereby your impairment of goodwill, because this is a full goodwill method, your fair value NCI method. So they have to share the impairment as well. So 40. And ultimately, your NCI at the year end will be at this value. So their investment value will also increase because they also have the rights on minority rights, so-called, in this subsidiary. So they will also increase in value. So this will be my working for me to put it under my statement of financial positions consolidations. And ladies and gentlemen, so since this is my working for full goodwill method, what about partial goodwill method? Partial goodwill method, you will see in here. So this is the partial goodwill method. And partial goodwill method, we will do the group retained earning as well. So group retained earning, we start at 3,000 and 2,000 as per question, like here. And minus my pre-acquisition retained earning 500, 1,005. So same things, I will share the 60%. But partial goodwill method, if you have impairment, sorry, you as a parents, you have to absorb everything because your NCI already carry at net asset value. So entire 100, you are going to absorb by yourself. And your NCI, no need to absorb impairment. So your NCI will be carried at 1,002. And there will be share of 40%. Okay, NCI will be carried at 600. So that will be fair valuations because this one is based on net asset lower. This one based on market value will be higher. So ultimately, their value will be still higher in this case. So when we try to do console, what will happen? Consolidated statement of financial positions as at 31st December 20x1. I'm going to tag my non-current asset first. So my non-current asset, because we are merging two accounts, so my non-current asset 3,008 plus 40 plus 4,000. Okay, plus 4,000. Okay, sorry, this is 4,000. So 3,008 plus 4,000. So that will be my total amount. And in here, since this investment in subsidiary, you already accounted under goodwill, so we will recognize goodwill. We will recognize goodwill under my non-current asset as well. So this is my PPE. Goodwill will be under working number 1. Working number 1, goodwill 400. And subsequently, there's a current asset. So in this case, current asset is 3,000 and 2,000. So 5,000. So you sum it up, that will be my first equations. You combine parent and subsi. Then your equity, your shares, still parent shares, 4,000. And your group retained earning, that will be your working number 2, group retained earning, 3840. And your NCI, okay, because you console already, subsidiary, there's certain portion is NCI. So we will recognize NCI, and my liability, I think it's current liability, 1000 plus 3000. Okay, 1000 plus 3000. So there will be 4000. And you sum it up, that will be the same. So this is your console SOFP. Likewise, for our partial goodwill method, we will use the same things, but the share is 4000 the same, but the retained earning now is 3008, and the net asset, the NCI is 1002. So you also balance. So this is the two different method under console, and they will give you the amount of difference in terms of the NCI and also the retained earning because of the impairment effect. If let's say don't have impairment, that will be straightforward. And just to let everybody know, this is an initial recognition, the goodwill. Goodwill actually is an initial recognition of your subsidiary. How to initially recognize? We are technically combining P, our own value, with our S value. So we take S asset, we take S liability, together we will merge with our account. So if we were to draw a double entry, if I were to draw a double entry based on my goodwill calculations here, so let's pay attention on this one. I have a debit and credit. So if I'm the parents, when I want to do consolidations for the initial recognitions of my subsidy, what will be my double entry? I invest using 1002. So I invest using 1002 considerations. So I will credit my bank 1002. Okay, I will credit my bank 1002. And at the same times, I will actually merge their account with our account. So that net asset, because I will take all their asset, all their liability, asset minus liability, all their net asset merged with my account. So I will recognize their net asset, debit their subsidy net asset. Okay, all their asset, all their liability, I will also recognize in my account. So their net asset is 1005. And because I am paying extra, I will have this goodwill. This goodwill, I will recognize as my non-current asset as well. And subsequently, this particular subsidy, they also consider NCI. They also got some other minority interests also invest in this subsidiary. I will recognize them as part of my equity. So 800 in here. Okay, so this is my goodwill 500. Sorry. Okay, just ignore the impairment. Just ignore the impairment first. Therefore, if you look at here, your initial measurement when you buy over this company as a subsidiary, you actually will experience this double entry, whereby you will recognize the net asset, the asset and liability of the subsidy in our company. And because you pay extra, you can recognize the goodwill. And because you console, you will need to recognize the NCI as well. And you paid for it for this investment. So can you see? Debit net asset, you plus 4,000, plus 2,000, plus 3,000 to recognize everything. And you debit goodwill, you recognize the goodwill. And then you credit NCI. You also recognize the NCI. Likewise, for this method, also the same. So this is the basic understanding of our consolidations of financial statement in terms of our goodwill, full goodwill method, and partial goodwill method. What about associate? If under associate, right? If under associate, we were using equity accounting method. So if let's say P whole over S. So let's look at P. So P invest 300 unit shares, and S that in the company got 1000 unit. So we know 30%. And this is an associate relationship, meaning to say we are the non-controlling interest lah. Okay? They could be other people, is actually their parents. So we are the S is our associate. So how are we going to account for that? And at the date, their pre-acquisition retained earning is 500. If it is an associate, that will be very simple. We will use equity accounting method. So equity accounting method, right? We are going to use our cost plus our share of retained earning. So meaning to say we will need to calculate the share of retained earning first lah. Our cost initially at 1000 because the invest in S is 1000. Okay, I call it as fair value of associate. Then I have to plus share of S retained earning. So how much is the share of S retained earning? We will need to depends on our calculations in the second part. Now, please follow me closely. We are going to calculate the retained earning. So let's use the template here. So using this template, P post-acquisition 3000, S post-acquisition 2000. And the pre-acquisition retained earning is 500. I will get 1005. And there's no impairment. Share of S retained earning 1005 at 30% because it's our associate. 30%. So our group retained earning is 3450. So this 450 we will include in our investment, our equity accounting method. So meaning to say we invest in this associate, we share their retained earning, and now our investment from 1000 value increased by 540, and our amount of associate, the carrying amount of associate at the year end become 1450. So very straightforward. If today you invest initially, what is the double entry? You will debit your associate, investment in associate as your cost of associate under equity accounting method, 1000, and you will credit your bank. Subsequently, when you have a share of retained earning, you will debit your associate value and credit your retained earning, because that will be the earning that you are able to get from them. So it's 450 and 450. So that will be the double entry. And when you want to do console, right? So what you are going to do? Definitely, you are not going to plus everything together. Definitely, you are not able to plus everything together. So your working will be slightly changes. PPE, steered, P PPE only. S cannot because it's not console. No goodwill, but you got associate value. So the associate value will be 1450. And you got your current asset of P, 3000. And you got your shares, 4000. And you got your group retained earning, 3450. No NCI. And you got your current liability, 1000. Sum it up. And you will balance. So that will be the simple explanations for equity accounting. That will be very straightforward. So now, you shouldn't expect exam come out in a two separate question because they will combine as one question. Let's take a look of this question so that you can better understand the situations in here. Now, so in this particular question, we got P, J, P, and S. So we have informations on here. J acquired 600 ordinary share of P for 1,000. So they actually acquired P for 1,000. So J invest in the first company is P. Later we calculate what is the percentage holding. Then we can know it is a subsidiary or associate. Second, at the date of acquisitions, the fair value of the freehold properties was considered 400 greater than the value. So this is your IAS 16 revaluation surplus, where at the date of acquisitions, there's a value of property actually higher than your market value. Actually higher than your book value. So you recognize that fair value adjustment. We call it as revaluations surplus. And this particular property, that particular subsidiary already bought it 10 years ago. That building portions is represent 50% of the value and going to depreciate for 50 years. But there's a 50 years of period for this building. They already used 10 years. So the remaining 40 years will be the amount that we're going to depreciate, the years that we're going to use to depreciate. Number 3, J-Co acquired S-Co. So that will be another company. We will calculate later. Number 4, P-Co sell goods to J-Co at a cost plus 25%, and J-Co held 100,000 of these goods in the inventory at 31st December 2005. This is URP. This is called interco company, that interco transaction that parents sell to subsidiary or subsidiary sell to parents. We will analyze later. And number 5 will be the goodwill impairment, and number 6 will be the NCI at fair value. So they value at $1.65. So we've roughly gone through the additional informations. Let's start. So in here, let's start with our group structures. So in here, group structure very important. So if you look closer in here, we have J and P. So J buy over P, they buy 600,000 of ordinary share, and in P company there is 1,000 unit of shares. So we are going to calculate, get 60%. So this is obviously our subsidy. Whereas looking at the additional information number 3, they say J buy over S for 225 units of shares. So compared over the total number of shares that S have, 30%. So this will be the most important informations. So one is subsidy, one is associate. Then at the date of acquisitions, your retained earning at the pre-acquisitions is 200 for P and S is 150. So that is our pre-acquisition retained earning. Let's register it first. Then working number 2 will be calculate the fair value adjustment first. So just now I've spoken to all of you. At the date of acquisition, meaning to say when they buy this asset, your value of asset is much more higher. The market value of the asset is much more higher than the value. You want to revalue it. So we are going to debit the PPE of of P, because this is P asset, and we will credit their OCI. In short, this credit OCI or reserve will increase the net asset, or we call it as equity, which will touch your goodwill calculation later. And you need to calculate depreciation, as I mentioned. The P actually use it for 10 years already. Then after 10 years, J come in to enjoy the asset. So still got 40 years useful life. And we are going to depreciate. 50% is building, another 50% is land. Land is not going to depreciate. So the building element, 50% is the value that we're going to depreciate, 200,000, divided by 40 years and times 6 years. Because from the date you buy this asset, 1st January 20X0, from the date you acquired P company until the date you close account is 6 years. So 30,000. That will be your depreciations as an expenses. You debit retained earning of P because this is P depreciations and credit freehold properties. Now, working number 3, goodwill. So goodwill, we have our considerations where the company paid 1 million to buy the company. NCI, because we have our total value of P at 1,000 unit. Since 60% you hold that, another 40% belongs to NCI. Times the market value of the NCI, because they say NCI value at fair value. This is called full goodwill method. If you have any impairment, need to share between parent and NCI. So you times with the market value, you will get a fair value of NCI at 660. And you minus the shared capital. So shared capital is this one, 1,000. And retained earning at the acquisition date, which is 200. And don't forget, just now I tell you, at the acquisition date, you got a value 400 greater than the market, greater than your carrying amount. So you want to recognize this revaluation surplus, which will also increase your net asset equity. So you have to increase by 400. So you minus it, you will get a goodwill of 60,000. However, item number 5 tells you that it is the policy of J-Core to review goodwill for the impairment annually. And the goodwill in P-Core, which is your subsidy, was written off in full some years ago. So everything that you calculated in the goodwill will be fully impaired. And later, this 60,000, you are going to share 60% to parent to reduce the retained earning, another 40% to reduce NCI. Because this is full goodwill method. We call it as NCI at fair value. Let's continue. Unrealized profit. P number 4. P-Core sell goods to J at cost plus 25%. And J-Core held 100,000 of these goods in the inventory. So let's assume you are the parents and you are selling something to your subsidy. And when you are selling something to your subsidy, right? This is the cost, maybe 90 ringgit. You always need to mark up certain amount, maybe 10 ringgit, to sell at 100 ringgit to your subsidy because transfer pricing issue. So if let's say I mark up the 10 ringgit to my subsidy holding this inventory. At the end of the year, you haven't sold it, subsidy haven't sold it to other people. The inventory consists of unrealized profit. Therefore, we will need to remove it out. Firstly, calculate how much is the URP. So markup. So 100,000 is the goods remain in the business. The policy is using markup. So 25 divided by 125. If margin, 25 divided by 100. So your URP is 20,000. So this 20,000 is hiding inside the subsidiary inventory. You will need to credit subsidiary, which is J's inventory, and debit retained earning that generated by P. So look at who sell the goods. The one who sell the goods, their retained earning will be removed the URP. The one who receive the goods, their inventory will be removed with the URP so that they won't overstep their inventory. So we are going to include this later in our retained earning and minus our inventory in the reporting date by 20,000. So we are ready for retained earning, which is the heaviest part. So we have 3 company, which is parent, subsidy, and associate, J, P, and S. Same things as per question, post-acquisition retained earning. And we need to minus the fair value adjustment, the depreciation in working number 3 just now. This one. We need to minus our retained earning 30,000 to reduce the retained earning. And we need to minus this URP 20,000. And we need to minus the pre-acquisition retained earning. For subsidy P, pre-acquisition retained earning at 200,000. for associate as pre-acquisition retained earning at 150. So you minus it and you share. P profit shared to J by 60% holding. S associate profit shared to J associate by 30%. And don't forget, your impairment is a full goodwill method. So impairment just now, the working to goodwill, 60,000, you are going to share 60% absorbed by J. And in this additional information, they tell you an impairment test conducted in the year and review impairment loss on investment in S core. This is your associate impairment. You also need to absorb. Associate impairment 92. Associate, you are the NCI. You don't have any NCI. So no need to share whatever things. Then sum it up. You will get 1785. So the next will be the non-controlling interest. If you are telling me that just now the retained earning 60% shared to you, another 40% will be shared by NCI. The initial amount will be referred to your goods view. Okay, fair value at NCI is 660,000 starting, increased by share of profit and minus with the impairment of goodwill because it's a full goodwill method. Again, 60% of the impairment go to parents, 40% of the impairment go to NCI. So net it off, your NCI will be valued at 890. Last but not least, the last working is your associate because you got S associate. S, they absorb, they will give you profit 72, and S investment on associate also got impairment. So equity accounting method. You will start off with cost of associate 500 as mentioned in here. 500,000 is your initial investment of your associate, and join to share the retained earning as per working 5 just now, and you need to minus impairment because you got an impairment in associate, and this will be the ending value of your associate. So what we are going to do, we are going to console J with P, don't console S. S is your associate, meaning to say don't combine with S, combine J and P. So that will be your answer. So if you're looking at this, we combine J and P plus our revaluations minus our depreciation, you will get net. And plant and equipment just plus the J and P. Goodwill and investment in associate. So investment in associate is the associate value increase already. And current asset adjust with J and P plus together, and this adjust with the URP. Equity, this is parent shares and plus with the retained earning, group retained earning together with the retained earning that share of P, share of subsidy, share of associate, and your non-controlling interest, and plus your P and J non-current asset and current asset. So you are going to get a console for both subsidy and associate. So this will be the entire so-called the thorough questions that examine the subsidiary and associate. So I hope you get something from this video. If you like my video, please share to your friends and do subscribe my YouTube channels for more accounting standards video. Thank you so much and see you next round. Bye bye.